Welcome back to the Catalyst Clock. Quick note, not financial advice, we're not licensed advisors, this is educational analysis only. Betting on chip stocks the same week one of them just had its worst trading day in history sounds like a terrible idea.
Right, but that's exactly why this week is worth paying attention to. TSMC reports earnings in 2 days after ripping 39.9% higher this quarter. SK Hynix just fell 15.4% in a single session. The kind of day traders end up writing books about.
Same industry, same AI boom, and they're headed in completely opposite directions. Let's figure out why. Start with the bedrock. TSMC's Q1 revenue came in at $35.9 billion, gross margin sitting at 66.2%, return on equity above 40%. For Q2, they're guiding revenue up to $40 billion. Call it 32% growth year over year.
And here's the number that actually matters. 6 out of every $10 TSMC makes right now comes from AI and high-performance computing chips. This isn't a general chip maker anymore. It's basically become an AI infrastructure company that happens to also make phone chips.
Exactly, and they don't miss. For straight quarters of beating estimates, 4 times in a row, Wall Street has guessed too low on this company.
Here's the catch, though. If you'd put $10,000 into TSMC back in April, you'd be sitting on close to $14,000 3 months later.
So the good news is already baked in. Analyst targets still imply another 12% upside on average, but when a stock sprints this hard into an earnings report, the bar for good enough gets a lot higher. Exactly, and they don't miss. For straight quarters of beating estimates, 4 times in a row, Wall Street has guessed too low on this company.
Here's the catch, though. If you'd put $10,000 into TSMC back in April, you'd be sitting on close to $14,000 3 months later.
So the good news is already baked in. Analyst targets still imply another 12% upside on average, but when a stock sprints this hard into an earnings report, the bar for good enough gets a lot higher.
This week specifically, a typhoon actually delayed TSMC's June sales release to July 13th. Investors only had about 72 hours to digest it before Thursday's print.
On the deal side, nothing flashy this week. It's execution. Watch capacity updates on their advanced packaging, progress on 2-nanometer chips, and whether full-year guidance gets raised. They're already planning to spend up to $56 billion this year just on new capacity. Now flip to SK Hynix, and the business itself tells a completely different story than the stock chart does.
Right, revenue hit $34.5 billion last quarter, up 198% year over year. The business nearly tripled in a single year. Operating margin sat at 72%. That's 72 cents of every dollar turning into profit.
This company controls close to 60% of the entire global market for HBM, the memory that physically sits next to NVIDIA's AI chips. Market cap crossed $1 trillion in May, passing Samsung as Korea's most valuable company.
So here's the real question. If the business is this strong, why did the stock just have its worst day on record?
Because a research note from Korea Investment and Securities projected next quarter's profit coming in about 8% below what everyone expected, not because anything's actually broken, but because they revised how fast memory prices would rise. On top of that, a geopolitical shock, U.S. airstrikes on Iran, a threatened blockade in the Strait of Hormuz, hit the entire Korean market at once, not just this stock.
Everyone else in the chip sector is priced like a luxury watch right now, 19 times forward earnings on average in South Korea. SK Hynix just got marked down to about 6 to 8 times, and nothing about the actual company changed overnight.
And while the stock was falling, the business kept moving. They're reportedly finalizing a 5-year supply deal with a major tech giant, positioning themselves as a primary HBM supplier. They're deepening ties with NVIDIA, already shipping next-generation memory samples to AI customers.
They also just pulled off one of the largest stock listings ever, raising close to $29 billion on the Nasdaq. That's not what a company in trouble does.
Alright, let's actually score this head-to-head.
Fundamentals, basically a tie. TSMC's A9, 4 straight beats, margins above 66%. SK Hynix is also a 9, nearly tripled revenue, 72% margins. Neither company has a business problem.
Valuation splits them apart. TSMC's a 6, it already ran hard this quarter. SK Hynix scores an 8, statistically cheap after this week's crash.
Technical momentum flips the other way. TSMC's sitting at an 8, strong uptrend heading straight into earnings. SK Hynix drops to a 4. You don't shake off the worst trading day on record in a week. The chart damage is real, even if the story isn't broken.
Catalyst clarity. TSMC's a 9, the event's dated, 2 days out. SK Hynix is a 6, earnings aren't until July 22, and the big memory upgrade everyone wanted got pushed back a quarter.
And risk. TSMC's a 6, mostly because expectations are so high now. SK Hynix is a 5. We just watched that risk play out live this week.
Add it up, TSMC averages 7.6. SK Hynix comes in at 6.4.
But those numbers are answering two different questions. TSMC's the sharper trade for this specific week. SK Hynix is the better price if you're building a long-term position and you're fine buying right after a scare instead of before one.
Two companies, same AI supercycle, and this week proved something worth remembering. Even the best business in the world can have its worst trading day for reasons that have nothing to do with the business itself.
Subscribe for the July 16th and July 22nd follow-ups.